Exports grew 21.4% YoY, higher than the consensus of 11.7% but in line with our 23.0% forecast. We believe that the cause of such strong growth is exporters' concern that the 10% tariffs on $200 billion of exported goods to the U.S. will rise to 25% on the 1st of January 2019, so they front-loaded export activities. Front-loading export activities should continue in November and December, so export growth data will continue to be stronger than in previous holiday seasons. As we expect President Xis meeting with President Trump at the end of November will not achieve positive results, the increase of the current tariff rate from 10% to 25% on $200 billion of U.S. imported goods from China is a high-probability event. We hope that the meeting will not damage the trade relationship further, as Trump once said that if the trade talks fail, then he could raise tariffs on all Chinese imported goods. Though U.S. demand will continue to be strong, import tariffs on Chinese goods could dampen U.S. demand for Chinese goods. We expect that some of these exports will be diverted to Europe. Whether they can also be diverted to other Asian economies depends on the extent to which those economies are themselves affected by the trade war, so strong export growth may not last very long. Export growth should slow under higher tariff rates. As such, we are not particularly optimistic on China export growth in 2019, especially in 2H19. China may not be able to enjoy strong U.S. demanding, Bloomberg, due to U.S. import tariffs imposed on imported goods from China. Front-loading is also the reason for strong import growth at 15.6% YoY, however, to a lesser extent as importers worry that future export growth will decline. But as China's fiscal stimulus has kicked off, we expect that imports of building materials for infrastructure projects, and imports of consumables due to tax cuts, will partly offset the slower demand for import materials for export manufactured goods. Imports could therefore grow faster than exports in 2019. We do not think so, as we believe that the USDCNY and USDCNH largely follow the direction of the dollar index. We believe under this trade war China will passively follow the dollar index to avoid being labeled a currency manipulator by the U.S., and to avoid further possible damage on trade and investments. Our forecasts on USDCNY and USDCNH at 7.0 and 7.30 by end of 2018 and 2019, respectively, are still intact.